Okay, good evening, guys. Tonight we have Dr. Jonathan Newman of the Mises Institute. We are very happy and delighted to have you, and you're going to lecture us about the threats of the CBDC, and you're going to speak about it from a privacy and monetary perspective. So the floor is yours. Kindly educate us, and thank you very much.
Well, thank you so much for having me. It was great to visit with Liren when he came to the Mises Institute. It's always nice to see people come from all over the world to the Mises Institute, and they come and they have stars in their eyes when they're looking at some of the things that we have on the walls and the items that are in our library, and meeting some of the people here. It's like you said, it is amazing the sort of impact that the Mises Institute has, and I'm very happy and blessed to be a part of this organization. You asked me to talk a little bit about the Mises Institute and what we do. The Mises Institute is an educational organization that is dedicated to Austrian economics, freedom, and peace. And our main guys, so to speak, is Murray Rothbard and Ludwig von Mises. Obviously, Mises is his name is in the name of the Mises Institute, and so their big books are sort of our guiding lights. The ideas that are in Human Action and the way that Rothbard systematized Austrian economics. It's really the foundation for all that we do here. And so our main goals is to educate as many people as possible about Austrian economics. And what makes Austrian economics unique is the way that we do economics. So if you look at the way economics is done in mainstream programs and in universities around the world, it's very mathematical, it's very empirical. They use a lot of mathematical modeling. They use very inappropriate simplifying assumptions about the way humans make choices, and so oftentimes they'll use this idea of homo economicus. So they will condense all human choice down to a utility function, and they will talk about firms making choices in a mathematical sort of way as well. But that's very different from the way that that Austrian economists do it. So Austrian economists use what's called praxeology. So we start with the basic fact that human action is the use of means to attain an end according to the actor's ideas. And then from that, with just a few very basic assumptions like the fact that leisure is a good, those sorts of things, we then deduce the rest of economic theory. And the result of that is what really distinguishes the Austrian school, at least in the way that is popularly viewed. A lot of people think about Austrian economics as very free market, very laissez-faire, against central banking, against government intervention. And the reason why is because that's where the theory leads us. That's where our thinking about economics leads us. We don't start with libertarianism. We don't start with this idea that government should be out of the way, and then try to construct economic theory to back that up. It goes the other way. So we construct economic theory, and it turns out that in doing it that way, there's really no room for the government to improve welfare. There's no room for the government to stimulate economic growth. And so that's why a lot of the policy prescriptions from Austrian economists are very laissez-faire. But it's worth pointing out that we don't start with those conclusions. We start with the solid methodology. We start with praxeology, and that leads us to a set of policy conclusions that most people would call radically free market. So that's a little bit about what the Mises Institute is and what we do and what our goals are. My talk for this time that we have here is on money. And specifically, I want to end up talking about central bank digital currencies, since that's a very popular topic these days. And of course, I view central bank digital currencies as a very big threat. So I think it's probably the worst thing that could happen to money ever since we went off the gold standard and we had a purely fiat paper money. So a CBDC would be terrible. But the way that I want to get there is I want to just trace through the history of money. And the reason I want to do that is because if you have the history of money in view, like where money comes from and how it has evolved over the centuries, then you'll start to see why central banks and governments around the world are starting to look at a central bank digital currency, why they're starting to think about it as a possibly good thing. And so let's just talk about what money is and where it came from. So I mentioned Ludwig von Mises, whose namesake is the Mises Institute. But one of his teachers or mentors was Karl Menger. Of course, more directly, it was Eugen von Bombawerk in Austria. But Menger was one of Bombawerk's teachers. And Menger talked about where money comes from. And he has this short book on the origins of money. And what Menger showed is that money is a product of the market. Money is something that comes out of the market naturally and organically or spontaneously. It's not something that's put into place by a state. It's not something that some king decides, oh, we're going to start using this piece of paper as money, and then people start using it. Menger showed that money develops on the market as a solution to what's called the double coincidence of wants problem. So in barter, where people are trading directly goods for goods, there arises this problem where you have to find somebody who will accept what you have in exchange, and you have to find somebody who is giving something that you want as well. And so that phenomenon is called the double coincidence of wants. And although it's easy to talk about, it's actually pretty difficult to achieve. So if you think about the sorts of things that I produce, which is articles and lectures on economics, I can't survive on that. And so in the market, I have to trade those things for the things that I want to need. And so I have a family that I want to provide for. And so I need to buy food. I need to buy shelter for my family. And so if I lived in a barter economy, it would be very tough for me to find somebody who is selling bananas, for example, and is willing to listen to a short lecture on economics so that they would trade me their bananas. So that would mean that I would be in a tight spot. That would be quite the predicament for me. It would be tough for me to survive and provide for my family. And so what Menger showed is that people would naturally start to think about ways that they can get what they want in exchange. What can they bring to market so that they would get the things that they want and need? And the answer is that people would start to view, they would start to think about ways to use what's called a medium of exchange. So instead of me trying to bring my products directly to market, I might find somebody who's willing to trade with me one particular good, and I want that good not for the sake of consuming it myself, but for the sake of me trading with somebody else so that I can get something else. So by going through that intermediary, by going through that medium, I'm able to achieve my goals. I'm able to acquire the goods and services that I want. And so to the extent that people realize that this is helping them achieve their goals, it will spread. So other people will see, hey, this guy used gold, for example, as a medium of exchange. Maybe I could do the same thing and I would be more successful in my transactions on the market. So if everybody starts doing that, if everybody starts using gold as a medium of exchange, so that they sell their items for gold and then they purchase their items with gold, then what we have now is not just a medium of exchange, but a widely accepted medium of exchange. And that's what we call money. So money is a widely accepted medium of exchange. And that process is what Menger talked about. He talked about how money originates in that way. So there's important elements there. One very important element is that gold has to be valuable at the start. So in order for me to start using gold as a medium of exchange, it means that somebody has to value it. I have to expect that somebody will accept it in exchange. And that element by itself just shows that the state version of the origin of money, sometimes called chartalism, where a king says, we're going to start using these pieces of paper with my picture on it as money, that shows that can't occur, because there's not a history of prices. There's no reason to expect other people to value that in exchange. And even if you do expect them to value it in exchange, there's still this question of, well, how much? Like, how much should I be willing to pay for these bananas? If a king has just dropped a bunch of these pieces of paper on the market, I don't have a price system that I can use to engage in what's called economic calculation. I can't make the important decisions without existing prices. And in a barter economy, the medium of exchange that emerges, according to Menger's narrative, is one that already has prices. There are already exchange ratios that exist when people start using that item as a medium of exchange. And so that explains how it can occur and why it must be the case that money originates on the market. And if you have that in view, then it goes to show, it explains a lot about the history of money since then. I'm going to walk through some of it, but what it means is that we should interpret the big events in monetary history where gold is outlawed, where we have banknotes with fractional reserve banking, where we have purely fiat monies introduced and central banking. And then more recently, there's all the talk about central bank digital currencies. If you understand Menger's version of the origins of money, it means that all of those events represent incursions on money. It's the state co-opting money. It's not the state perfecting it. It's not the state offering something on the market that people are willing to accept voluntarily because they have to impose legal tender laws and other interventions to make sure that people will use the government paper, for example. And so with Menger's theory of the origins of money in view, you really do see that all of these events that have happened, it's the state co-opting money. The state did not start money. The state has only taken it over. And so the purely fiat paper monies that we have today, it's not something where it's not a product of the market. It's not people deciding that this is a better money, that this is a more efficient money. It's governments saying that we want people to start using this money, and we can discuss its purposes in doing so. But it's definitely a product of the market. People like to talk about the different functions of money, and we've already talked about one function of money. It's the medium of exchange, and that's where it takes two transactions to get what I actually want in the market. So instead of directly exchanging the thing that I have, I go through an intermediary, I go through a medium. But that means I have to sell something for money, and then I use the money to go get something else. So that's why it takes two transactions to get what I want. But if everybody is using that and they're pricing all of their goods for sale in that same money unit, it means that we now have a unit of account. It means that we now have something that serves as a common denominator for our calculations. It means that businesses can think about the revenues that they would earn, and all those revenues are in one common unit. And they can think about the costs that they would pay for the factors of production, and they're also in the same unit. They're denominated in the same money. And so businesses could now do profit calculation. They could engage in economic calculation and decide how much in very small detail with very precise prices, they could decide how much they're willing to pay for factors of production. And so this is it's an underappreciated function of money. A lot of times we just talk about the medium of exchange function of money, but really the unit of account function of money is what makes civilization possible. So we could not have an extensive division of labor We couldn't have multi-stage structure of production if we had a barter economy. So the fact that businesses can engage in economic calculation with the common money unit, it means that production can lengthen. It means that we can specialize. It means that we can evaluate factors of production and decide how to use them in the most productive, most efficient, most valuable way. So that function of money, it's connected. It's very close to it's tied to its function as a medium of exchange, but we can discuss it separately, and it is extremely important. But one other function of money that people talk about is the store of value function. And I think this is a little bit shaky, although we do like the fact that we can save something and it retains its value over time. There's really no guarantee in a free market that something will retain its subjective value over time. And the reason why is because valuations change, demands change, even the demand for money changes. And so there's nothing guaranteed about money that would make it necessarily a good store of value. However, we can see empirically that when we had sound money, when we've had free markets, and when we've had an extensive, even international division of labor, we have consistent deflation. We don't have inflation, which is what we're all used to these days. We have consistent deflation. And what deflation means is simply that your money is gaining in value. Your money is gaining in purchasing power over the years, which makes it an excellent store of value. It makes it an excellent vehicle for saving and delaying your consumption and extending your thought process into the future. If you can know that the amount of money that you're setting aside today is going to have, it's going to not just retain its value, but possibly even be more valuable in the future because prices consistently go down with a stable money supply and output expanding. So that's the store of value. Really, the store of value function simply means that you can separate those two exchanges that I referred to when I was talking about the medium of exchange function of money. You can separate those exchanges by a certain amount of time. And as we've seen historically, when we have sound money and free markets, that value is preserved over time. Certainly the nominal value is preserved. So if you have a 1 ounce gold coin, that's always going to be a 1 ounce gold coin, for example. Okay, so people settled on gold and precious metals because of its ability to satisfy those needs. So gold is divisible, it's malleable, we can use it in exchange, it's homogeneous, and so it makes for a good unit of account, especially if it's refined and it's got the stamp of its purity by some minter that has a reputation on the market. So the reason why we settled on gold is because it was very good at satisfying those very important functions of money. We didn't settle on paper because paper is easy to print up. It would take a ton of paper valued just for its use as paper to accomplish the transactions that we'd like to do. But you could carry around a silver coin or a gold coin, and that's good for the transactions that you would need on a day-to-day basis. So that's why the market settled on those precious metals. And of course, as you all probably know, governments co-opted it. So even in ancient times, governments realized that they could clip coins, they could debase the metal that was in the coins, and so they could introduce another a baser metal that has lower value into the coin, and that way that would decrease the gold content of the coin. And the reason why they would want to do that is because they could benefit as a result. So they could raise funds that way. They could finance all of the things that they wanted to do. So, and one reason why they would want to do that is because taxes are very unpopular. Everybody realizes that taxation is unpopular. Nobody likes to be taxed. And so once the government realized that they could finance their activities by debasing the currency, this was great for them. They realized that they could They could spend more. They could wage more wars because they were able to collect more money, more gold than they would have to if they were just relying on taxes. Governments also resorted to paper debts, and governments would promise to repay, but they frequently discounted, or even they would totally go back on their contracts to repay, and they would run up huge debts during wars. But then we had the advent of fractional reserve banking, and this was huge economically and psychologically. Psychologically, the advent of the banknote and fractional reserve banking, it meant that people now started associating their spending ability, their purchasing power, with pieces of paper, as opposed to the gold that the pieces of paper represent. And so that was a big psychological step. People started to connect spending with paper as opposed to the metal. But economically, what it meant is that the state could now use the banking system as a method for inflation. So they could sell their debt to banks, and then the banks could keep only a fraction of deposits in reserve, and then the banks could earn interest by lending out the extra to people. And so now banks were on the line for making those promised repayments as opposed to the state. And the money supply was much more elastic. They could expand it greatly because of fractional reserve banking. But of course, that didn't really solve the problem, because all that does is that puts banks on the line for default. That means banks are now responsible for making the payments to depositors, as opposed to the state having to pay down debts, or the state being on the line for doing coin clipping or debasement of the metals. So, obviously this created perennial bank failures. And so banks would go out of business, depositors would come requesting their money, and they would run out. And it was because of all of these bank failures and the repeated banking panics that we had central banking come on the scene. So in the 20th century, especially, although central banking is older than that, but in the 20th century in the US, we had the formation of the Federal Reserve. So central banks became very widely used. They became very popular. And the reason why is because they could cartelize and regulate the banking system. And by regulating the banking system, they could make sure that no one bank would overextend its lending, so that it would be subject to a more severe bank run compared to the rest of the system. But a central bank could also act as a lender of last resort to banks, so they could bail them out. And also the central bank would finance the government by being a ready buyer of government debt. So the central banking really solved a lot of the problems for the state, even with fractional reserve banking in place. But of course, even still, there was this problem in the form of gold redemption. So gold redemption still got in the way, and in the U.S., gold was outlawed. People were forced to stop using it as money. And we had the Bretton Woods system put in place, which allowed just foreign governments and foreign central banks to redeem their debts, their U.S. dollars for gold. But the average citizen was not allowed to do that. And then even that system fell apart because the U.S. was inflating, and gold was draining out of the U.S. And so in August of 1971, Richard Nixon went back on the Bretton Woods system, and he said, we're no longer going to be redeeming dollars for gold. And so what that meant is we had a fully paper fiat system. And if you look at any sort of time series, if you look at any series of like government spending, government debt, other sorts of macroeconomic variables, you'll see that there's an unhinging. You'll see that things are sort of going along up until the early 1970s, and then things take off. There's an unhinging of all of these time series. And that's because for the first time ever, the central bank was set loose. There was nothing except paper now. So there was now no more threat of gold redemption that would get in the way. So fast forward a few decades, and we've realized that even cash now, paper cash, is too much of a constraint for the government. So cash offers anonymity for the users, which the government doesn't like. The government likes to know what people are spending their money on. They want to be able to collect taxes. And so because of that, they want the money that's traceable and something that is connected to the person, and cash isn't good at either one of those things. But also importantly, cash demands by depositors constrain fractional reserve banks. So to the extent that I can still go to my bank and request cash, then I'm constraining the bank. I'm constraining the amount that the bank can expand its lending through fractional reserve banking. So now cash is viewed as this big constraint. Yet governments want a way to be able to inflate as much as they want to. They want to be completely unhindered in their inflationary goals. So that's why a central bank digital currency is viewed as the solution to this problem for the state. So if you think about what a central bank digital currency would be, is that it's purely digital. And so it's not anonymous. It would be connected to the person who owns it and has it in an account. If it's an intermediated CBDC, then the private commercial banks would offer accounts, but that's basically just a front. It's basically just a facade for you banking directly with the central bank. But the central bank digital currency would be totally traceable. It would not be anonymous. The government would be able to see and approve of or disapprove of anything that you're spending money on. It would definitely help with tax collection as well. So they're very much in favor of this idea for those reasons. A couple other things that I'm not seeing talked about as much is the fact that a CBDC is programmable. So governments have long wanted this ability to impose a negative nominal interest rate, and they've never been able to do so, except that there was this experiment in Japan with that, but that wasn't like a fully fledged negative nominal interest rate for everybody using yen. But governments around the world have wanted to do that. And the main reason why is because they're under this Keynesian delusion that an increase in spending is what we need to get out of a recession. So if we're in a depression, obviously what we need is a bunch more spending. So they view a depression as a collapse in spending. So the answer is we need to increase spending. And of course, they view the ability to impose a negative nominal interest rate as a way to really stimulate spending by everybody. And the reason why is because a negative interest rate is simply a tax on holding money. So if the government were able to tax money that's in an account, then if we have a system where we still have cash, then people would be able to withdraw the cash. People would be able to pull it out, and they would be able to preserve their purchasing power that way. But if we have a central bank digital currency totally replace paper cash, it means that now there's no way to pull cash out of the system. There's no way to pull your purchasing power out of the banking system, which means that the government would be able to do that. They would be able to tax holding money. They'd be able to impose a negative nominal interest rate. So this would also mean that there's no more constraint on fractional reserve banking. So banks would be able to extend with zero limit now, because now there's not even the ability for people to pull cash out and force a bank run. So a central bank digital currency, for those reasons, it offers a lot of benefits to the state. It takes away the anonymity, introduces programmability. It's fully traceable. They can impose negative nominal interest rates. And also there's no longer this constraint on fractional reserve banking. And I just want to talk a little bit about what the Fed has done recently that leads me to believe that a central bank digital currency is around the corner. So in the 2008 crisis, the Fed started doing these brand new things that people had never seen before. The Fed started buying mortgage-backed securities, whereas before they would only purchase government debt. But now they were buying private assets, which means a bunch of things. It means that they're creating winners and losers in the market. They're sort of bailing out one particular sector at the expense of all other sectors. But also it means that the Federal Reserve's balance sheet would expand. They did bank bailouts. So they were choosing winners and losers. They said, we will bail out these banks, we'll bail out these financial institutions, but we won't bail out those. there were huge increases in its balance sheet, more than anybody had ever seen. So they had these so-called quantitative easing programs that allowed the Federal Reserve's balance sheet to just grow more than anybody had ever seen before. And that's why a lot of people were worried about inflation after the 2008 crisis, is because the money supply was increasing dramatically. But we didn't have the price inflation during that time period, but it's coming back now. Another thing that the Fed did was that they hit the zero lower bound. So they pushed the federal funds rate, the main interest rate that they target, all the way down to zero. And that was brand new. They've started lending to maiden lane corporations. And this is just sort of like a shell game for them. It's a way for the Fed to be indirectly invested in private businesses around the economy. So now they're not just buying mortgage-backed securities, they're not just buying government debt, but they're invested in private businesses everywhere now because of these maiden lane corporations that they've set up. After COVID, there was a huge increase in the money supply. So it was a $6 trillion increase after the pandemic. And so that was unprecedented as well. They've also set up the bank term funding facility, as well as many other lending facilities. And what this has done is it has institutionalized the bailouts that they started with in 2008 and 2009. So and another aspect of that that's very strange and brand new is that banks are able to offer as collateral government debt and other assets that are valued at par, as opposed to their market value. And so that's why it's institutionalized bailouts, is because these financial institutions are able to get very nice loans. They're able to borrow way more than they would on the free market. And it's because of this new intervention by the Fed. At the beginning of the year, we had some bank failures in the United States. So Silicon Valley Bank, Signature Bank, and some others failed. And another unprecedented thing happened, in which the FDIC, the Fed, and the Treasury worked together to insure those deposits, even the ones that were above the FDIC maximum of $250,000. So that was brand new and unexpected. And another brand new and unexpected thing is that the Federal Reserve is now incurring over $100 billion a year in losses for the Treasury. So usually what happens, since the Fed has this huge balance sheet, they've acquired all of these assets, and those assets pay them interest. The Fed will take some of that to cover their operating costs, to employ all of the economists that they have on staff, and pay for the building and other things. But anything that's in excess of that, they will remit to the Treasury. So the U.S. government was able to acquire this great source of funding for a long period of time, because the Federal Reserve was remitting all of these excess earnings to the Treasury. But now they're a drain on taxpayers. Now they're suffering these huge losses, and they've used these creative accounting tricks basically to disguise that fact. They're calling their losses deferred assets now, as opposed to true losses. And so what that means is that now, in a very fiscal way, taxpayers are on the line. Now taxpayers are suffering because the Treasury is not getting that bonus check from the Fed every year. And that's brand new. Okay, so I just went through a list of like brand new, unprecedented things that the Federal Reserve has done. And I've also talked through the history of money and how governments have co-opted money over time. And I think the trend is that we're going towards a central bank digital currency. They're going to try to get rid of cash. First, they'll discourage it. First, they'll do whatever they can to get people to stop using cash with, we'll say, strong encouragement as opposed to pure force. But I do think eventually they will get rid of cash and we'll just be on a purely digital dollar. And I think other central banks around the world will do the same thing. I just recently saw an announcement from the European Central Bank that they are moving in that direction, that they're going to start implementing a digital euro. So it's something that's definitely coming. And the fact that we've seen all of these unprecedented brand new things from the Fed recently, it shows that they have no constraint on their power. They have no constraint on what they're able to do legally. So like there's nothing that's really binding them. There's nothing that's really preventing them from going outside of their scope. And that's evidenced by all the brand new things that they're doing. So in my opinion, a central bank digital currency seems like a natural step. And my own anticipation, if I can do some prediction here, we see a lot of these new things that the Fed started doing happen during crisis periods. So like the bank bailouts and the purchasing of mortgage-backed securities that happened during the 2008 crisis. And then we also had the $6 trillion increase in the money supply after COVID and the bank failures that happened during the same time period. So, and this is something that it's a general observation. Governments grow during crisis periods, whether that crisis period is a war or whether it's an economic crisis. Governments, they expand in size and scope during those crisis periods. And so what I think we'll see is that in the next crisis, maybe like the next big crisis, is when they'll try to implement a CBDC, and they will do it under the guise of they're trying to placate markets. They're trying to respond to the crisis. They're trying to protect the U.S. consumer. They're trying to do all these nice things. When, as we've seen through the history of money, all they're doing is they're just trying to protect their ability to inflate. They're trying to protect their ability to extract resources from the private economy in a subtle sort of way. Because that's what inflation is. Inflation is just a way for the government to pull resources out of the private economy in a way that's not as unpopular as taxes. So the effects of inflation they're subtle and they're delayed and they're complex, which makes it hard for the people to actually assign blame. Whereas in the case of a tax, it's very easy to assign blame. So when I get taxed, it's very obvious who is taxing me. So when I have to pay my taxes, I can very easily blame the government. But it's not so easy to blame the government and the central bank when I see that prices in general are rising, when I see gas prices are higher, when food prices are higher at the grocery store. And so because of that's why governments love inflation. That's why governments want this ability to inflate without any sort of hindrance. It's because they're able to finance all of the things that they want to do in a subtle sort of way. And so I just want to include by reviewing something that I said in a recent talk. Give me 1 second here. So if you look at all of the reports about central bank digital currencies, they're always talking about the pros and the cons, the costs and the benefits. They'll say that there are some risks, but we're going to try to mitigate those risks. We're going to design the central bank digital currency in the best way so that it's good for everybody. And so they're issuing all of these sophisticated reports, and they're trying to make this utilitarian claim. They're trying to say that on balance, it's going to be good for everybody if we get this authority to issue a central bank digital currency. And I was just recently reading Murray Rothbard's For New Liberty, where he was talking about utilitarianism and another way to view the world, which is through the lens of natural rights. And so let me just read this quote from Murray Rothbard. And while I'm doing it, think about the utilitarian arguments for a CBDC, like ones based on convenience or alleged financial stability, removing the drawbacks of cash. Think about their arguments while I'm reading this. So here's what Rothbard says. There were two critically important changes in the philosophy and ideology of classical liberalism, which both exemplified and contributed to its decay as a vital, progressive, and radical force in the Western world. The first and most important, occurring in the early to mid-19th century, was the abandonment of the philosophy of natural rights and its replacement by technocratic utilitarianism. Instead of liberty grounded on the imperative morality of each individual's right to person and property, that is, instead of liberty being sought primarily on the basis of right and justice, utilitarianism preferred liberty as generally the best way to achieve a vaguely defined general welfare or common good. There were two grave consequences of this shift from natural rights to utilitarianism. First, the purity of the goal, the consistency of the principle was inevitably shattered. For whereas the natural rights libertarian seeking morality and justice cleaves militantly to pure principle, the utilitarian only values liberty as an ad hoc expedient. And since expediency can and does shift with the wind, it will become easy for the utilitarian in his cool calculus of cost and benefit to plump for statism in ad hoc case after case, and thus to give principle away. And then Rothbard concludes this. He said the utilitarians found it easier, ever easier, to slide further and further into statism. And I read this quote at the end of a talk that I gave at the Mises Institute a couple weeks ago. And here's how I concluded it, and I'll leave you with this, and then we can do some Q&A. So Rothbard's discussion here tells me that while there is a time and place to get into the weeds, showing the immense threat of a CBDC in terms of what it would mean for taxpayers, depositors, and anyone who uses the dollar, ultimately we should reject it and the whole idea of central banking on principle. And what that means is that programmable money means programmable citizens, and sound money means free people. Thanks.
Thank you very much. It was incredible. I would like to understand, if you can elaborate, if they are going to have full control over the digital money, how they are going to balance and preserve the purchasing power of buying money, because eventually they are going to inflate and inflate and inflate. Where does it get the purchasing power to do anything after they will, I don't know, they will get rid of the middle class and all those who are saving money?
Yeah, it's a good question. And the answer, I think your answer is great. I think if there's no constraint, then we will see a very steep withering away of the purchasing power of money. And the way that works, if you read Mises and Rothbard, the way that works is that it happens slowly and then all of a sudden. So once people realize that dollars are losing in value, or any currency is losing in value, then they stop demanding it. They stop holding on to it, and they unload it. They sell it on the market for other things that will retain their value. And of course, that action of selling things on the market, that actually works to further decrease the purchasing power of the money. So we get this rapid decrease in demand for money once that happens. And of course, what that results in is a hyperinflation. And so we saw hyperinflations in Weimar Germany. There was one in Zimbabwe that was famous, and there are other ones around the world. And so what happens is people stop using the money. The money itself becomes totally useless because it lost all of its purchasing power. There's some funny pictures of ladies going to the grocery store, and they're bringing a wheelbarrow full of cash to make their purchase. Or you'll see kids playing with big stacks of cash as like building blocks or as toys. And so I think obviously you can't do that with a digital currency. Like you can't play blocks with with the digital currency. But we would see the same sort of thing happen to its purchasing power. It would just go away to zero. And what happens when that does occur, when we have hyperinflations, we have monetary replacement. We have some other money will take its place. And I don't want to make any predictions there, but I think we would see people around the world switch to gold or cryptocurrencies like Bitcoin. I think they would switch to something that they know will retain its value and won't tank in value like the dollar or other hyperinflated currency would.
Eventually, if all the states are going to move into digital currency, maybe eventually in the end, they are going to consolidate it into one world currency. And if they do that, maybe they are going to say, okay, from now on, you can only use that. You cannot exchange it with anything else. They are going to outlaw it. And what do we do then if that's going to happen? And I think we are heading there. What do you think about that?
I'm not sure. I mean, that sort of depends on geopolitics. That depends on whether governments and central banks want to retain their ability to inflate at different rates compared to what other central banks and other governments are doing. It's not impossible, but I would say that it's difficult for me to see the Federal Reserve relinquishing its control over the dollar. It's difficult for me to see the Bank of England relinquishing its control over the pound, or other central banks relinquishing the control over their currency. And the reason why is because they use it to finance their own governments. And so when their own government runs up huge debts, then they can rely on the central bank to inflate more. And when they have lower spending, periods of lower spending, then and inflation is becoming unpopular, then they can let off a little bit. So I think countries would probably want to retain the ability to do that. But you're right, it's not impossible that we would see more currency unions, international currency unions, like the European system.
Mm-hmm. So how they are going, if it's going to remain, for example, just in the States under the Federal Reserve with the US digital dollar, eventually they're going to inflate, and you will have hyperinflation. How do they stop this cycle? What will happen in the end? Will it become Weimar and everyone will sell the dollar and escape to gold or crypto? Or what the government can do without crashing?
Yeah, so if they inflate, as you say, then really the only outcome is hyperinflation and eventual monetary replacement, where people do switch to something else. They might switch to some other currency that's used elsewhere in the world, or they might switch to gold, or they might switch to Bitcoin. I'm really not able to make a prediction along those lines, but I can say that if and when we do enter a hyperinflation, then really there's no way to unwind it. There's no way to come back from that. Really, the only way out is through, and that means hyperinflation, monetary replacement.
Okay. If I may ask about the U.S. debt, it's already 33 trillion or more, and you have unfunded liabilities to the amount of numbers that I can't even speak. What's happening with that? How is it that it's still maintaining itself and doesn't crash?
So, I mean, that's a really good question. And I think the reason why is because while the Federal Reserve is doing everything that it can to finance government spending and debt, it's the fact that other currencies around the world, other central banks around the world, are staying in lockstep. Or they're not inflating it as much, or they're inflating just as much, I should say. And so I think like the reason why we haven't seen the hyperinflation of the dollar is because we just haven't gotten to that point where consumers are so dissatisfied with their declining purchasing power that they're willing to switch to another currency or something like that. So we haven't gotten to that point yet. And I think the reason why is because people still view the Federal Reserve as the extremely solvent buyer of government debt. And so that's why government debt has been able to increase as much as it has. It's because it has a money printer that's ready to buy all of its debt, and nobody questions the solvency of the Fed. People are just now starting to question the solvency of the Fed because like I said in my talk, they are starting to incur these massive losses. But because the solvency of the Fed has never been in question before, that's what allowed the U.S. to increase its debt so much. And it is a staggering number, the $33 trillion number. I remember when I was in college, we were surprised at the level of debt that the government was in, and now it's double that. And college wasn't too far away from me. So it's not just that the number is super high now, it's also that the rate of the increase has skyrocketed as well.
Mm-hmm. I would just like to verify about a few things which are like a bit of a conspiracy in regards to the Federal Reserve. I understand that there is nothing federal about it, and it's basically a private entity. So first, maybe you can speak about it a little bit and tell us who are the real owners. Does it belong to private hands? Second, how much of the purchasing power of the dollar fell since 1913 when you have the Federal Reserve? And what happened in 1925 or 35, I forgot, when they confiscated the gold? And do you think they are able to do it again?
Yeah, so there's three questions there. You might have to remind me of them when I get to them. But it was 1933, I think, when FDR confiscated gold. And that was eventually found out just I can't remember how long after, but that was eventually found to be unconstitutional by the U.S. Supreme Court. And so people were able to go back to owning gold. But they did stop bank redemption. So they stopped people's ability to redeem their pieces of paper for gold at their banks. And that never returned. So even though they announced it as like this temporary measure in the Great Depression, people never got the ability to get their gold back. They just had to use the paper dollars. Your second question was about how much the purchasing power has declined.
Yes, sir.
Mm-hmm. And the number that I've seen is 97%. So 97% of the purchasing power of the dollar has vanished since the Fed's founding in 1913. Now, a lot of people, they hear that number and they're a little bit confused because they think, oh, if the dollar has lost 97% of its purchasing power, then how am I able to buy anything? And the answer is that while prices have risen, wages and salaries and incomes have also risen at the same time. Well, actually not at the same time, but in stepwise fashion with each other. And so that's why we're not all dirt poor here in the United States. It's because while prices have come up dramatically, our incomes eventually come up as well. And the reason why is because anytime you sell something, that's an expenditure for you, but it's income for somebody else. And so if prices are rising, then both incomes and expenditures are increasing. Okay, and then your first question was about the ownership of the Fed. Now, the Fed it's a really strange sort of organization. It's quasi-public, quasi-private. People like to say that it has independence from the federal government. Of course, if you've read any Rothbard, then you realize that that's just like a total farce. The Fed is not independent. The Fed has always financed U.S. government spending. So like there's no independence really, except for the fact that the Fed does not have to be audited by Congress. So even though the U.S. Congress is what created the Fed, Congress doesn't have the authority to look in and check on the books or even have any sort of sway over its goals. So the Fed has taken on this goal of 2% inflation, but that was not approved by Congress. Like nobody in Congress, the representatives of the people, nobody said that we wanted that. Nobody said that 2% inflation was a good idea, and so that's something that the Fed just decided on its own. So to that extent, it's independent in that it doesn't have to run things by the Congress. But it is a creature of Congress. The leadership of the Fed is selected by the president. And so in that sense, it's sort of like a government body. But you talked about ownership of the Fed. And this is also a complicated question. And the reason why is because on the books, so officially, the Fed is actually a Federal Reserve system. So the Fed is a system of regional reserve banks. So there's one that's based in Atlanta, Georgia, which is right next to where I live in Alabama. There's one that's based in San Francisco, one in St. Louis, one in New York. There's all of these Federal Reserve district banks that exist around the U.S. I think there's 12 of them in total. And they collectively make up the Federal Reserve System. Now, that's how it was supposed to be. It was supposed to be sort of decentralized, where the policies that each one of these district banks would implement would be relevant for the region that they represented. And then there was this board of governors, in Washington, D.C., the U.S. Capitol. There was this body that would make some decisions that would matter for the whole country. But what we've seen now is that really all of the decision making is in Washington, D.C. All of the important stuff is done by the board of governors and the Federal Open Market Committee, which is in Washington. But I realize I still haven't answered your question of who owns the Fed. So the Federal Reserve System is all these district banks put together, but the district banks they charter banks in their region. So like they will charter banks that exist in their own region, and those banks are required to hold stock in that district bank. So technically, all of these banks, the regional banks and other banks in the United States, they own stock in their district bank, and the district bank is one of many other district banks that make up the Federal Reserve System. So that's who owns the Fed. It's the banks themselves. Now, here's where it gets weird. It gets weird because I mentioned that the Fed has incurred all of these losses, right? So the Fed is incurring $100 billion a year losses. And the reason why is because interest rates have come up. So they have all these assets on their books that are earning them about 2% interest. So it's like mortgage-backed securities and long-term government debt. That's earning them about 2%. But right now they're paying over 5% for reserve balances and for their reverse repo operations. And so there's this gap. And that's why they're losing all this money. So if you understand that the Fed is technically owned by all of these banks, shouldn't they be on the line for these losses? And the answer is yes, like they should. Like if they're the owners of the Federal Reserve System and the Federal Reserve System is incurring all these losses, then they should be on the line. They should be making up the difference. But instead, what has happened is taxpayers are on the line. So now all taxpayers are the ones who are suffering the losses because it's hurting the bottom line of the federal budget, as opposed to making all of these banks around the country pay up. So I know that's sort of a long answer to your question.
No,
but
it's very good.
That's good.
So as usual, it's always the taxpayer who has to suffer the consequences of bad policies.
Yep.
How long more can you stay with us, if I may ask?
Just a couple more minutes.
Couple more minutes. I will just ask my friends if they have a question. Guys, anyone wants to ask a question?
Yes. I want just to clarify the long answer that you had about the Federal Reserve. Hi. First of all, thank you very much, Jonathan, for your lecture and your time. Yeah. So just to clarify, the Congress, like the public representatives, created the Federal Reserve, but they can't observe this institute and what they do inside of it. So there is no regulate, like they made it legal by law, and they can't observe nothing that is happening in there. There's a regional branches that control all the regional banks. So my question is, who owns the bank?
Well, that like private banks are owned by stockholders and by some closely held owners of banks. It depends on if the bank is private or if it's publicly owned. Like some banks, like Bank of America or Wells Fargo, anybody could be an owner, but just by buying stock in it. Is that what you mean?
I mean that banks are private institutes that are getting legalized by the same body that authorized the Federal Reserve. And the Federal Reserve is the owner of the banks. So it's like the same. It's the same. It's a cycle.
Yeah. Well, technically, the Federal Reserve does not own the banks, but it does regulate the banks.
It controls the money.
It works to cartelize the whole banking system. So all of the private banks are subject to the rules that the Fed puts in place. It used to be like minimum reserve requirements. They have capital requirements. They have rules about interest rates that you could charge, all sorts of things.
I see. Okay. Thank you very much.
Yeah. Thanks for your question.
Can I ask you something which is not related to the subject, but it's related to free market?
Oh, sure. I can try.
Okay, I think it might be a little complicated, but please bear with me. Let's assume that we are successful and we got rid of the state, we got rid of this delusional belief in authority of others, and we exercise our, natural law and freedoms, and we have a free market. But before we move into this free market, we have a beast here that we have to deal with. The country is already organized in a very specific way, all the systems, all the organization, private properties, and a lot of property that belongs to the government. How do you reshuffle everything? How do you reorder society at the very beginning in a way that is not going to create new problems if you already accept the notion that you want freedom?
Yeah, that's a great question. And it's something that I do think about. I don't think about it a lot, but I think the most painless way to do that would have to be first decentralization. So first you've got to take away power. So I'll use the U.S. as an example. You got to take away power from Washington D.C. and return it to the states, and then the states have to return their power to the counties and the cities that make up the state. So first you've got to make a big push for decentralization, so that eventually or slowly the power gets back to where it should be, which is at the most local level. But in terms of like what to do with the resources, I think the best solution is auction. So the federal government owns a ton of property in the United States, and we have this huge amount of debt. So I think the best way to go about it, that would be the most painless way to go about it, would be to auction off that property, auction off the resources to the highest bidder, and then use those proceeds to pay down the debt. And then if there's still any debt remaining, then the people who hold the debt, they have to be the ones who suffer the loss. And if there's anything extra, then that would have to be remitted back to taxpayers, people who pay their taxes before. So those are just some quick ideas that I have, because you're right. We don't want like mass chaos. We don't want fighting in the streets. If everybody's interested in freedom and we're interested in getting rid of a central government, we want it to be as painless as possible. So I think auctioning and decentralization is the way there.
Okay. How do you limit homesteading? If someone is going to say, I'm forceful, I'm strong, I decided that from this point until this point, it's all mine, okay, and I'm going to start homesteading it, now it's mine. And he's taking a unproportional piece of land with a lot of resources. What the other people can do if they don't want to be violent?
I have to be honest with you. I don't know the answer to that. That's more of a question for a Walter Block or somebody who reads a lot of Walter Block stuff. And I highly recommend that you read his stuff. And maybe Walter could. He was here?
Yeah, 3 times. Yes.
Oh, okay. Well, I would definitely save that question for the next time that he visits.
Okay. Last question, if I may. You
Sure,
described earlier.
question.
Okay, thank you very much. You described earlier in the very beginning that Austrian economics eventually comes to the conclusion that freedom and no state is the best way, but that's the conclusion. And you said that you take it from different economic models, and you take it from human action and praxeology. Can you give us like an example on like to take us step by step from the beginning of that understanding to the final conclusion of how you get to freedom? You understand what I mean?
Yeah, I would recommend that you check out Human Action, or maybe more especially Man, Economy, and State. So in Man, Economy, and State, that's where Rothbard starts off with human action, and then he develops economic theory. And like a few hundred pages in, it's where he's starting to get to some of these policy prescriptions where he's saying, so it seems like the result that we want would be free markets and laissez-faire. But I can give you just like one quick example of what you're looking for. So if you just think about voluntary exchange, so action is one person deciding how to use their means to attain some end. Exchange is when 2 people are doing the same thing. So 2 people are working together, they're acting in concert so that they can trade property. And if you think about what a voluntary exchange means, it means that there's mutual benefit. So if I'm offering an apple to somebody and they're offering me an orange, and this is a mutually beneficial trade, it means that I value the orange over the apple, and the person who's receiving the apple prefers the apple to the orange. So this is a welfare enhancing result. So both people are getting something that they want. Okay, so now take that result and think about how could a third party improve that? right? So how could a third party improve that result between those two people? And the answer is that they can't. The only thing that a third party could do is prohibit that exchange, or make one person pay more than they actually want to, or do something else that would intervene in that welfare enhancing, mutually beneficial trade between those two persons. So, and that's my go-to example when I talk about the way that there's no room for the government to improve outcomes on the market. The market economy is just the sum total of all of those mutually beneficial exchanges. So everybody is engaged in all of this exchange that's voluntary and it's mutually beneficial. There's nothing, if there's nothing for a third party to do to make that outcome for one exchange better for both parties, then there's nothing that a third party could do to make the economy better for everybody with all of their exchanges. And that's what the government tries to do. So I don't know, does that satisfy you? Is that a good step-by-step process?
I think I will go back to the book, but yes, you gave some idea. That book is difficult, I must tell you.
Read Man, Economy, and State.
I bought it, but I must admit it's hard for me. My English is not good enough for that, but I will struggle, and eventually I will understand it better. So I think our time is up. You have to go, right?
Yes, thank you so much for having me. This has been a pleasure, and I'm definitely open to doing something like this again. So have Liren try to reach out to me again. I'm sorry that I missed his last few emails. It seems like I don't know, maybe he sent it to a wrong email address or something. But I'd be happy to visit again. Thanks, everybody.
Thank you very much. It was incredible. I will send you here on the Telegram in a private message the recording of the video so you can have it. And if you allow me, I will further communicate with you, perhaps to have another lecture if you're willing, okay?
Sure. Thank you. You'll have a good day.
You too. Thank you very much.
Thank you very much.
Jonathan.